So let's say you're in I guess, an emerging market. So like South Asia, South Africa, Latin America. And you're making money online, but revenue is not domestic, but it's international. Well, those countries that you mentioned, so if you're in Southeast Asia, you're in one of the ASEAN countries, or South Africa has one of the most aggressive tax authorities in the world, and they're becoming even more aggressive. And I guess Latin America is kind of like, it's a mixed bag. The point is, if you are working online, running a business online. And that's why I think, the whole idea of a technology company is redundant, because every company needs to have technology on its core. So, I mean, you're running a typical company, which means that using technology, you're doing something on the web. Remember in the slides, we spoke about the concept of Nexus. And then we spoke about the place of effective management. Even though you are doing something online, management and control is being exercised somewhere. You are resident somewhere. You're living somewhere. If you're a resident in South Africa, if you're sitting in Bali, if you're sitting in Colombia, you are running a company online from that jurisdiction. Even though you may not have any clients in South Africa, even though you have no clients in Bali and you're sitting in Bali, even if you have no clients in Colombia and you're sitting in Cartagena, Medellin, it doesn't matter. You are running a business from that jurisdiction. You're spending time there. You may be tax resident in that jurisdiction. It doesn't matter that the money is being collected in another country, in another bank. It doesn't matter that the company is incorporated in another jurisdiction. You, as a key decision maker, you are there. So therefore, legally, that company has already been pulled into the tax net of South Africa, of Indonesia, Bali, of Colombia. They already have a legitimate right to tax that company and deem it to be domestic, because the place of effective management is local. And so that's where I say one size doesn't fit all. And I tie this back to the previous question being asked. One size does not fit all. And for those who want to paint with a broad brush, the answer to everything is Belize, the answer to everything is Estonia or Panama, whatever the case may be. It really depends on the individual circumstances. Tell me about that individual. What is their citizenship? What are their residencies? Where else are they legally resident? We need to find that out. We need to find out the nature of their business. Where are their customers? Where's their economic? Where are they banking? Where are their suppliers? Where are they warehousing? Because warehousing could create Nexus as well. So once we have the picture of that individual and the business, we can make an informed choice. But otherwise, understand that the whole concept of Nexus means even if your customers are not in the country where you are, even if the money never comes in, sometimes that makes a difference. So for example, I know with Thailand, that does make a difference. Or if you're under the remittance basis in Ireland or in the UK, if you're res non-dominant claiming remittance basis. So, okay, generally speaking, right? Generally speaking, you're running a company from that jurisdiction. Even if you're banking somewhere else, even if the customers are somewhere else, the place of effective management is that jurisdiction, and that jurisdiction typically reserves a right to tax you and tax that company as well.
Please subscribe, like, share, and comment below. Our books and upcoming events are available at htj.tax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.